You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are delighted to be back with this week's edition of the Systematic Investor series, which is our weekly open-ended and pretty raw exploration of the world of rule-based investing, and where we also take some of your questions. So good morning, Jerry. Good morning, or I should say good afternoon to you, Moritz. How are you?
I'm doing fine. Hi, Niels. How are you?
Good morning.
Very well. Good morning, Jerry. So a interesting start to the new year. Lots of action in this first week, and of course finishing off with a pretty volatile Friday after the unemployment numbers came out. Sadly, I think the moves seem to be against most trend followers' positions, but we'll talk about that, I'm sure, in a little while. But why don't we just tee up as we normally do with sort of a quick review of what happened last week. And then, as promised, last week we said we were going to spend a little bit more time on talking about 2018 as for the year, give our more detailed comments to that. So we'll definitely do that before we get back into the usual topic. So Moritz, if I can come to you first. First week of Jan, how was that?
First week of Jan, yes. For a change, that has been a good week, even though I'm not sure if saying for a change is right, because December has been good also for me. But so this past week, I mean, I'm long the bonds pretty much in all the countries, US, Japan, Australia, Canada, UK, Germany, and those made really good money. Of course, the exception to that is yesterday, when most of those bonds dropped again. But overall for the week, it's still been a good trade. I'm short the Australian dollar since quite a while. That's a gift that keeps on giving. Mm-hmm. So that's good. Got shorter on oil. That was one of I remember us talking about that, where, when it started selling off, we were saying, well, we're not short yet. And I think in general, some were saying that trend followers have been late to jump on that trend. But then, it kind of like looked at it as if it were bumped out at like 50 and still it went lower. So that made money. I'm now short the equities pretty much across the board. Again, good trade this past week. So not complaining at all. Of course, there's also, few losers. Still have a short silver position on. That doesn't look so good, but well, what can you do? Natural gas, again, still a bit long there. That was a loser. So, well, that's it.
It's always nice to have a good start to the year. Yeah. Absolutely. Yeah, I mean, it's pretty volatile, I would say, overall. The first few days of the year for us were pretty good. Somewhat similar markets that you mentioned, certainly making money from the fixed income moves to the upside, and then the short side of equities. But of course, big reversals yesterday, which pretty much for us gave back the week and a little bit more, but nothing too dramatic. And also, generally speaking, because of the increased volatility and the increased correlation in our portfolio, we tend to that triggers essentially our risk budget being lowered automatically. So so overall, I would say at the end of the week it looked like a quiet start to the new year, but certainly during the week there were lots of action, and it'll be super interesting to see whether these moves are just corrections on the back of a bit of news and some good data. Because that would be, if it's not a correction, if this is really starting the beginning of a turn, then yet again, within a pretty short period of time, we're having another big transition in both fixed income and equities. So, which is never easy to handle for trend following systems. So it'll be super interesting to see what happens going forward. But yeah, overall, relatively quiet at the end of the week, but with lots of volatility inter-week. How about you, Jerry? What was it like for you?
Similar, of course, except in the stocks where the single stocks, I can still find a few that I'm still long. So I'm on the opposite side of, I like it when the stocks go up. I'm still net long, so that helped me yesterday, but a lot of counter trend action this week, especially Friday, in currencies and metals. So no sustainable trends. I'm too diversified. I have markets go up for me, and then I have some that I lose money in, so nothing sustainable and fun. Unfortunately, my prediction a few weeks ago about what was going to happen in natural gas, I think I bought contract highs and I think I exited at contract lows. So unfortunately, it feels really bad. I think that's okay, to have a system that makes you feel bad as long as it's going with the trend and taking small losses. But we all kind of prefer to have not to give back almost all or of that nice profit that made a performance look a lot better earlier this year.
Yeah, I mean, it's interesting. You mentioned that. I mean, what actually made us the most money last week was Japanese government bonds. And if you think about that and you think about how low interest rates are in Japan, a lot of people who were just coming maybe at the market from a non-rule based point of view would say, well, how can it possibly be profitable to still be long, JDBs? So you're absolutely right. I mean, we just don't know what's gonna happen, and the thing that we need to do and the thing that investors pay us to do is to follow the process wherever it takes us. So yeah. Now, we did promise last week to do a little bit more in-depth analysis, or at least talk about 2018 as a year, because it was one of those years where I don't think many, if any, of the typical asset classes that we as investors overall follow made money. Certainly was very few and far between. And so it was a very unusual year. And so why don't we talk a little bit about that and how, the three kinds of trend following that we practice, fared through the year, from maybe a little bit about which markets were interesting, or maybe some overall themes that changed during the year. Can I start out with you as usual, Moritz, and see how, because you also did the best of the three of us anyways. So,
the best being down minus 3.8.
Exactly. Small losses sometimes can feel pretty good.
Yeah, so minus 3.8. So my system didn't handle the equity indices very well, it seems, in 2018. Of course, there has been, a long position, and that was profitable, especially in the U.S. markets. That was a very nice and clean up trend at the beginning of the year, pretty much continuing throughout the summer. Of course, February was tough, but then we had Red October, and when I sum it all up, equity indices, they've produced the largest loss in the portfolio. The largest loser, FTSE, followed by the DAX, followed by the SPYs, that's the Australian market. So that hasn't been that good. In terms of the currencies, it's been long the US dollar against pretty much any other currency. And that's been a good trade for the first half of the year. I remember making good money by being long the US dollar against the Australian dollar. That's still the case. That's still a good trade, nice trend I like being in. Got a bit tougher now toward the end of the year with the Japanese yen being the classical safe haven currency. Short the yen, so took a hit there in December. Energies, relatively late to jump on the short oil trade, but believe it or not, still made a bit of money there. So I like that. Natural gas had that breakout, I remember. I think we were all in that, buying natural gas. Unfortunately, turned around. That wasn't good. Precious metals made money in 2018. Got a, changed a short gold position into a long gold position. That was good timing. And then the biggest winners, the bonds. And I really like the way the system handled those bonds throughout the year. Being short pretty much in not all of the markets. Still had some long positions on throughout the year in Germany and Japan. But certainly have been short the US bonds across the spectrum, different durations, and probably just at the right point in time changed that back to long. And so that made the largest contribution to the portfolio.
Interesting. Very interesting. I mean, we certainly saw a few themes happening as well. I mean, starting out the year, incredibly long equities and actually long on the fixed income side as well. And then we started seeing these shifts in exposure, overall exposure. I mean, we went short fixed income, mainly US fixed income. But it took our overall exposure short relatively early on in the year, which did well and certainly helped deal with some of the challenges in equities, which of course end of January, early February was where the biggest losses were recorded. Also the biggest wins in January for sure, but we certainly paid that back in February and then the big shift for us was again later on in the year where we saw fixed income for a short while flipping to the long side. This could have been driven by some of the short-term interest rate contracts as they have quite large nominal values, but from the information I'm looking at, we had that flip, and then we went back on the short side from fixed income pretty much until sort of November time when fixed income started to rally, and that has taken us from being pretty short to going long around December time overall. So that meant we added to our European longs, which had been long, I think, pretty much all year. And then the US shorts flipped towards the end of the year, and that took the whole interest rate sector, to the long side. And that certainly, made some money for us, but still, as like with you, Moritz, specific U.S. markets on the bond side didn't do well, and also UK fixed income, the long gilt, didn't do well for us last year. Equities, so quite a mixed bag, by the way, I should say. That's one thing I've noticed, which was unusual, in my opinion, is we had very much, very diversified positions, even within the same sectors. So we certainly saw in the fixed income that both long and shorts were on, depending on which region of the world, at the same time, which is a bit unusual. You have normally more of a synchronized move in fixed income, but not this year or not 2018. A little bit the same picture in the US on the equity side and versus Europe. US equities, we kind of stayed long for the most of the year until recently, a few weeks back. But the European fixed income, equities turned much earlier. So we actually ended up making money in things like the DAX for the year, but did lose money in most other equity markets. And currencies were mixed. There were a few winners, a few losers, but overall, I think pretty flat. And then on the commodity side, I agree with you. I mean, certainly a bit slow to get into the short side, and also, a bit timid in terms of positioning on the short side of energies. But net gas overall for the year did well. We actually overall made money in crude and unleaded, but we lost a little bit in heating oil and gas oil. But overall, probably a flat year for energies. And then biggest winner for last year was coffee. Coffee followed by sugar, which is pretty interesting. I mean, that's, I think, part of the diversification people like with CTAs, is that we can pull out profits from markets that many people don't trade. So that was interesting. On the other hand, we did pay dearly in some of the other commodities, mainly the grains. The grains were very difficult to trade for us. So that's where we probably had the most concentrated loss, meaning that pretty much all of the grains except for soybean oil actually did poorly. And then mixed bag in meats and same as you, made money in precious metals, pretty flat in base metals. So a mixed year overall, obviously a tough year for us. We raised the returns from 2017, but it's just 1 year in a much longer time frame. And again, what I would say, just to put these things in perspective, when we talk about performance and trend follows performance in general, and people might say, oh, that's not so nice if you're down 5, 10, 15%, whatever it might be. But when you take that performance and you adjust for the volatility of our strategies versus the volatility of equities, then equities actually had, at least compared to us, equities are in a bigger drawdown at the end of December on a volatility adjusted basis than we are, even though we had a bad year. And I think people need to realize that being down 10% for equities with a low volatility is actually, quote unquote, a bit more risky than being down 10% for a trend following strategy, certainly that we follow, where you normally have much bigger swings and so on and so forth. So yeah, that was kind of how we saw the year on our side. Look forward to 2019 and see what opportunities will arise. How about you, Jerry? You probably saw 2018 slightly differently, maybe to Moritz and us, but how did it play out?
Oh, it was really painful to listen to all that. Need to get 18 behind me. I think one of the ideas, though, was there was just a lot of counter trend action. No long-term trends. Coffee was a good trade. It's kind of a sort of a sign that when CTAs talk about their best trades being shorts, the majority of the portfolio maybe being short, that probably was going to be difficult to be a good year. 2014 was an exception, of course, but we've got to get some longs going and get some bull markets with low volatility, and we just haven't seen that in quite a while. There's pockets, palladium was good. Emissions was probably the best trend of the year. Try to focus on some positives here, but just a lot of counter trend. I just looked at some of my individual stock charts, and maybe it was a negative on the stocks for the year, but some of those trends were really large and multi-year trends. So there were good trades, but not good performers in 18. So I think that's our bottom line should be, how did I handle the trade? Was the trade itself great? And did it seem like my systems did a fairly good job of when there were trends? Did I botch it, or did it do a fairly good job? And so, and not so much, how did it do in 18 or for a particular month? I've definitely had clients ask me over the years, and I came in one year with a client in January, and the client asked me, you're down for the year so far, maybe it's February too, and then your biggest loser is sugar. And I'm like, sugar? I mean, that's like one of the best trades I've had in years. And so they're so focused on, no, not the trade, but this month. Can you help me this month? And I'm like, no, I can't help you at all. I crushed sugar. I made more money in sugar than anyone else. It's an A+. Oh, but not for this year. So you got to try to get beyond that and kind of ignore that.
Yeah, definitely. And also, I think that a lot of the discussion last year was, of course, the fact that, it's the thing about diversification, right? Diversification works eventually, but people expect it to work all the time. And I think that's the challenge that you're also referring to here, that, people shouldn't judge these strategies based on a month or a quarter, or even a year's performance. And we certainly won't deliver, quote unquote. And also people should, I think, also understand that the diversification doesn't mean that we can flip negative returns into positive returns. It just means that we will overall help people to avoid really, really nasty experiences, over the long run. But last year was, as I started out by saying, one of those years where not many strategies did well. So diversification didn't really work to some extent. And we have to accept that it doesn't work all the time.
Jerry has just mentioned a very interesting contract, the emissions contract, which was such a nice trend this past year, and even before that, until it sold off so heavily. I think in October, had a couple of days where it's like -7%, -8%. Of course, that market is correlated to power, to energies, but so this, looking at that market, that was a great long position, so made money from that. But ever since that sell-off, the behavior of that market has apparently changed. So when I calculate the volatility of that market for the past 3 months, 4 months, it is now much, much higher than it used to be. That trend is kind of like, flatlining now. I think we're at 24-ish, something like that, per ton. And remember, once had that discussion about, vol targeting. Of course, we spoke a lot about vol targeting. So this is one of the things where I still have that trade on with the original position size. And I'm seeing that, more pronounced now in my portfolio because just that market has started to become more volatile. I hear it has to do with a possible Brexit and what that means for the contract and the European Union emission trading scheme they have there. But so that's definitely a market I'm watching right now.
Yeah. Good stuff. Hopefully that was helpful just for people to get a little bit of color to 2018. So why don't we jump back to our usual rhythm and find out what Jerry's top tweets were in this first week of January, and any other good stuff that we all came across in the sort of the industry news flow in the past few days. But let's start out with you, Jerry. What got a lot of attention, maybe a lot of love from your tribe this past week?
Not a lot going on this week. Holidays, maybe it was my fault. One of my favorites didn't get a lot of, no one else thought it was that great, but quoting David Harding reviewing 2018, his quote is, "We have become famous as a trend follower. That's a great thing. It gives you this reputation and franchise, but it's also a bit of a prison." And my comment was, "Lock me up." But I think there was a couple of good tweets this week, good articles that I tweeted, and they had the same philosophy, and it's the same subject, just two different people talking about the same thing, and it's really in our wheelhouse. This is red meat for all of us trend followers. Okay. So my people loved this idea and a couple of times, and this was a quote from a very famous hedge fund person, and fundamental value, I suppose. And of course, everyone knows but me, because I make a point of not really knowing that with anything outside of what I do, pretty much. And his quote is, "In a rational environment, my strategy functions well. But in an irrational market where blah, blah, blah takes a backseat to clicks and momentum, my logic does not count for much." And of course, we think that's really ridiculous. We follow prices. We are perfectly happy that your logic, your way of looking at these fundamental metrics and analysis that have worked for hundreds of years. Oh, they're not working anymore? Yeah, we told you that. We told you should follow price and expect relationships and fundamentals that have looked like they've worked in the past to maybe not work. And quit trying to be an expert on stocks or long stocks or value, and follow prices, follow trend, and expand your portfolio to hundreds of markets, currencies, commodities, stocks, bonds, long, short, and force yourself to look at price only, because this will not be the last time that your quote unquote logic, and it's sort of like an arrogant thing too, where we get beat up, and hopefully the trend followers say, I got beat up and I need to improve my system or stick with it. And it's our fault, kind of. We're not blaming the rest of the world for our ideas and our trading not working. And it's a road that leads to nowhere.
Yeah, no, absolutely. There's no point in making excuses. But it's interesting because I think a lot of the quote unquote big stars in sort of the non-quant world that a lot of people love because they can put a story behind their investments, and that seems to be doing well on the financial media, but they didn't do so well last year either. And there are some big names with some big losses. And there are quite a few, closures of people who've been around for a long time. And it's this thing about, have things changed? Will this, never work again, et cetera, et cetera. But I mean, in our case, we're kind of used to things not working because they don't really work most of the time, but they suddenly work really well. And if you're not used to that, and if you're not used to maybe dealing with losses and so on and so forth, then it can sometimes lead to people bailing ship and closing down, which is really not nice for clients. If a fund closes down at the bottom of a drawdown, so to speak. But of course, better than continuing if really they have no ability of making money again. But interesting. What else attracted some attention?
I think the second article I tweeted on the same subject is worth reading as well. And it goes like this: when someone says it makes no sense that, really what they're saying is this: I have a dozen logical reasons why XYZ should be going higher, but it keeps going lower. Therefore, that makes no sense. But really what makes no sense is their model of the world, right? So I know when that happens that there's some other very powerful reason why XYZ keeps going lower that trumps all the, quote, logical reasons, unquote. I think that sort of humbleness of approaching the markets is the essence of risk control, which is what we should be doing with our systems and diversification. And it's fine. I think approaching the markets like we do, that we really can't predict, we really don't know. We're not the smartest person on the planet. No, these markets are crazy and wild. And if anything, historical patterns and relationships are there to fool us and suck us into thinking this is going to continue in the future. We know better. I do think that we can fall into the same trap of expanding a little beyond price only into maybe relationships and filters and things that make common sense that should help our trend following, that really could be a little counter trend or a little overfitting. Back in the day, filter was a bad word for turtle traders because it sort of signified that, you can filter out trades and not take certain trades. And of course, that could be death to the trend follower to filter yourself out of a big long-term trend.
Yeah. Any thoughts, Moritz, on your side about these things?
Yeah, agree with all of that. Also, looking at some of the tweets, there's one that I liked is, it's an innate tendency of humankind to project the present state of things into the future indefinitely. In so doing, we create one of the most important and exploitable market anomalies, momentum. That is Jerry's tweet. I think you retweeted that from where you found it somewhere. And that's so true. I think that is the nature of humankind. You project the current present state into the future indefinitely. You think, it's all going to be rosy or all going to be bad, and that creates that momentum. I agree with that. And another one I liked is the one by Cliff Asness. What did he say? I think 2018 felt crappy, and then when asked to expand on that, he said it felt significantly crappy.
Yeah, he's the best. Still blocked, but still.
Yeah,
I think he's
still trying.
Just great. I mean, the David Letterman of finance, incredibly smart person.
Yeah. He had a great, not a great, but he certainly also took up an issue with someone tweeting this week about, I think it was an article and I can't remember, is it JP Morgan or Nomura, whether this guy has made a name for kind of coming out and suggesting that, all these quant funds are the ones creating the problems for the markets and creating the sell-offs and all of that. And he was just basically saying, instead of just making these claims, I mean, show us the evidence and so on and so forth. And I want to make the same point that I think I did last week. I mean, a lot of what's happened in the last few weeks where we see big sell-offs in equities, I don't think has anything to do with what we are doing, because most trend followers have been short for a while now. But I think it has a lot to do with these passive funds where they see their flows, and the flows have suddenly turned, to outflows instead of inflows. And the last week of these trading days, where they come in with their algos to basically adjust their portfolios, and so this should not be confused with anything to do with trend followers, in my opinion.
And I think, but once again, we can find our own problems in wanting things to be a certain way and not paying attention enough to price only. So we have to be on guard for our weakness in this particular area. Another great quote I picked up from one of my following a new person, and this guy's full of wisdom, and he's just fantastic. I find myself retweeting quite a bit, and I can kind of see how I agree with this quote of his, which is, the most ironic risk in investing is education. The benefit of learning from experts is clear. The downside is sticking too closely to what's worked for others, and so lack of creativity in you. Great investing is learning the rules from experts and then bending them to your own. And my comment on the retweet was just good enough, no more. Yeah. And I think that's sort of what Price is saying, just good enough. Don't want to be too much better than that, because maybe being better is an illusion. It's overfitting, it's too many filters, it's getting away from a very diversified portfolio that's just looking at the price trends. So once again, I think said a different way, maybe almost the same thing, but and I think a lot of the sticking too closely to what's worked for others could be a problem, in that, do we really know what's worked for others? Were they lucky? I'm not sure I like the word bending, but it's more like over the years, my worldview and what I believe in trading, I have learned a lot from others and copied others, but it still had to fit into my worldview and not violate all the other things I learned up to that point. I mean, I guess I could have been so far off base that maybe something could still do that. But you do have to own it yourself. And so often there's no really way to know exactly what other people are doing, or know that you're even sticking close to what has worked for others, because you really can't really even tell. But I never dismissed ideas and that conflicted with my own over the years, until I had vetted them incredibly well. And I essentially ended up adopting a lot of them, and reading interviews of traders and listening to the podcast and Top Traders Unplugged. Such a great educational for traders, but you have to be careful.
Yeah, and I think we've made this point before, and that is, there is no such things as the best system. I mean, just looking at performance numbers this year, I mean, there's a big spread between the great systems and the worst systems, and it just shows that, even if you're labeled a trend follower, we still do things differently. So there is no one right solution, as long as you follow the rules and so on and so forth. That's the process is what you should focus on. So yeah, interesting stuff. Maybe I mean, you can go back to more tweets, but one thing you shared with us, which I think was interesting, was this analysis by Jez about different trading models and how they had performed in 2018 and so on and so forth. And he produces a lot of, good information on trend following and so on and so forth. And I don't know whether we should just talk a little bit about some of the conclusions from that information. I mean, obviously we have no way of checking the numbers. We just take it for face value, but it certainly seemed like there was a tendency to the shorter term, different types of models performing better last year compared to the longer term models, which certainly would be our experience as well. But did you have a quick look at what he shared, and what are your views on that?
I'm not surprised. I had a look. So just to give some background on what we're looking at here, I think the firm Jez works for is his firm's called Trading Blocks, and he analyzed a systematic trend following system, I think trading 50 futures markets across different time frames and different styles. So he's looking at Bollinger breakout system, a channel breakout system, dual moving average systems, and triple moving average systems. So the triple moving average system, the difference there to a dual moving average system is that it has a neutral zone. It needs agreement between the moving averages. And then he looked at that over different time frames, short term, I think starting at 20 days or even, 10, 20 day moving average crossovers. So that's very short term. All the way up to longer term time frames, 200 days and even more. And what you see there is that the shorter term systems, regardless of style, they all outperformed the longer term systems. And that reflects what we've seen in this past year. I mean, I remember speaking about crude oil. We haven't all been that quick on getting short there, whereas some of the short-term traders, they got the turnaround there pretty much instantly and benefited from that. In general, the short-term traders did well 2018 versus the longer-term trend followers. So looks like an accurate representation of what happened in the past year. And it also shows that diversification across timeframes and system styles is valuable, because what Jez also produces is the composite return. So I guess that's just the simple average across all the systems that he's analyzed, and that's plus 7.5% for the year. So that's a mix of short-term, medium-term, and long-term trend following systems.
Yeah, it was interesting to see that the worst performing of all of them, I think, is probably the most well known, and that was the 5,200 day moving average. So that was interesting. Maybe too many people are following that, but anyways, yeah. Did you have some views, Jerry? Or
yeah, I think this is the story of 18. Is that every now and then the things that have worked over the longer period of time and worked the best, they will look poorly compared to parameters and systems that one, if doing a reasonable back test, would never choose because they haven't made money, let's say. And so I think that short term had a, and that's what when I think about 18, I see the chart patterns that historically would make one desire to trade longer term, which is a sell-off, let's say, but then a retracement back to new highs enough of the time or in a magnitude where the computer says you should be medium to long term, which is what the industry is built on, and looks similar to the 20 by 500 or 20 by 50 by 250 or 200. The industry, the CTAs are caught not trading those shorter term systems. Great, because they don't really work over time. And sometimes crappy stuff works and the good stuff doesn't work, or we're all wrong and we need to transition back to shorter term. In other words, that's fine too. I think trading as short term as possible is preferable, but not too short term to where you don't make money. But if we're going to get it to a stage maybe where now trend following is going to be easy, we don't have to have these drawdowns that we suffer with the medium to long term, and we're going to have these smooth trends. AI is going to come in and keep the markets right on trend for us, and the least little bit of rally to the 20-day high or the 50-day high, we know we should just get out. That's great. It's great for us. We can now go back to the 70s and 80s. I doubt that's going to occur. I doubt that's the right idea, but I certainly think other things in our firm that we have added to our systems, slight tweaks with single stocks and longer term, and a few other little things we look at they all failed miserably as compared to shorter term trend following with no bells and whistles, no added value. And it's tough, but it's not to be unexpected. I've seen it before.
Yeah, no, absolutely. Okay, so that was another look at 2018 from a slightly different angle. So I think with that done, I think we should jump over to take a few questions that we have that came in. And by the way, thanks for that. And do keep your questions coming. Just send them to info@toptradersunplugged.com or tweet them to one of us. Probably Jerry is the best one to tweet to because he is more on Twitter, I think, than Moritz and I am. But one way or another, get the questions to us and we will be delighted to discuss them. Now, last week's by far winner in terms of questions was George, and George has kindly sent a couple of follow-up questions for this week, which is great. Appreciate it very much. And he asks, how much risk measured as a percent of portfolio AUM to the stop per trade do you think the legends of the 70s and 80s were taking to generate their amazing returns? Well, Jerry,
a lot.
Since you're one of the legends,
a lot.
Let's hear it. Let's get the dirty secret out.
It was a lot, no doubt. Also think that during that period of time, you cannot forget that very short-term trend-following systems were working fine. So once again, if our trailing stop and our stop loss is relatively close to the market, and the systems have a positive expectation, then that's sort of what's needed in order to make 200% a year, which is what we did for 4 years. Now those systems and that time frame doesn't work any longer, so it's a little irrelevant. Plus, no one can even back then. I mean, I had a negative 60% day once, so I was still up 140 for the year. So that's not a business model, I don't think. And that strategy and style is totally gone. So risky.
And
go ahead.
Yeah, no, I was just going to say, I think that is an important point, right? That the risk levels you're talking about, was while you were in the Turtle program, not when you started taking on external clients' money. So it changes things when you suddenly have to deal with external investors who may have completely different risk tolerances. But I guess overall, maybe it's fair to say that even from the beginning of you taking on clients and other firms, I just don't have the numbers for done, so I can't really share. I don't know how to qualify that. But I think it's fair to say that probably the risks that we all take today is somewhat lower compared to back then. But I also want to caveat it by saying that what we've seen on our side is actually our annualized returns have increased compared to the long term, including back, the 70s and 80s and so on and so forth. So one have to be careful. It's not just about what is the risk per trade, but it's also how well we are evolving as risk managers, that helps in that sense. Anything else you want to add, Jerry, since this was something down your wheelhouse, I guess?
Yeah, I mean, I think it's very important to trade small and have a low vol, 10 to 12 or 15 or whatever you're comfortable with, so you can stick with your system and you can keep your clients. So that I would turn my back on. It was a magical time. It was not real life, and don't think you can do that any longer. And I've said before on the podcast that the medium to long-term systems have always worked better than those shorter-term systems. Probably not in the sense that you wanted to try to make 200%, of course, but it's not like we've evolved into looking at recent data or data prior to the 90s or 2000s in order to these medium to long-term systems. They do really well. and they've always done well.
Yeah.
We should have been trading these systems from the get-go.
True. Maybe, and maybe, Moritz, you have some thoughts on the second question from George, which goes on to say, while each system and drawdown tolerance is different, what are your general thoughts on reasonable or unreasonable risk percentage, of AUM per trade? Do we have any views on that?
Yes, I do have a view on that, but I can only speak for myself. I mean, that number depends on how much heat or risk you're willing to take and accept, and how firm and steadfast you are in your trading approach. As far as I'm concerned, risking more than 1%. So that's 1%, right? Not 10, 1. Risking more than 1. That's not for me on any given trade. And I'm risking even a bit less than that. So that is what I'm doing. Other people may be risking more per trade, maybe 2%. But I wouldn't feel comfortable with that. Maybe at some point I will, but right now I do not. And of course, it also means that, you have to have a system that allows you to size your positions as in that way, right? So say you have an average true range or R multiples, those type of things, then that works. Whereas, some of the trend following or simpler trend following systems, like say you have a moving average that doesn't have a predefined stop because it will, stay long or short until there's another cross of two moving averages, then that is not the type of system that this calculations work with. But yeah, like I said, I mean, around 1, a bit less for me.
I think it's just it's part of the back test and part of us choosing different parameters. You'll get seemingly different answers, but you can trade 50 markets or 40 markets or 100 markets, thinking that you can even risk 50 basis points in every energy trade: crude, heating oil, unleaded, Brent, and gas oil. Oh, I'm only risking 50 basis points. No, you're risking a lot more than 50. It's the same trade, basically. And so it depends on your back test and your stop loss. How close is your stop loss? If your stop loss is one ATR away and you're risking 25 basis points, you're going to have a lot of losses. You're going to have a low win percentage. You're risking less than everyone else, but then why are you eating into your capital quicker than anyone else? So all these things play into each other, and you have to just really but I would say anything greater than 1, I can't even imagine it. So that would violate, there's nothing you can massage with your systems or your back test to go to 1 or 2%, but 25 to 50, I think that's probably where you want to be. Dependent upon
there are people out there that apparently trade at greater than 1% risk, and they're still out there and alive and kicking. Of course, they produce more volatility. One example there, I think, if I remember correctly, is Tom Basso. He said it. He's like, he was risking less than 1% when he was trading client money at Transted. But ever since he closed it down and essentially returned to trading his own money, he said, well, he himself is comfortable in taking on more risk because he no longer has to answer to external clients. And if I recall that correctly, he's now trading at greater than 1% risk per trade. And of course, there have been people then like at Coder and those that have probably traded at much larger risk sizes.
Yeah. And the other thing to remember, I think, is that, even if you were running a simulation and a backtest over a certain period of time and you used 1% risk per trade and you said, yeah, no, I can withstand a drawdown of X, whatever it comes to. I mean, one should always be aware of that in the future that you probably will experience even bigger losses. So don't think about whatever you see in a backtest as being, it can't get any worse. I mean, it certainly can. And I also would say that especially during these, highly correlated moves we've seen recently, 2018 being, a good example of that, then some of these seemingly, diversified portfolios can become incredibly risky. So as Jerry and Moritz said, don't be too brave when it comes to that. Okay, great stuff on that. Then we have a question. Let's do that as the last question. There's a lot of sub questions in that. I think I'm going to read all of it to you, and then you can pick out the points you want to talk about. Generally speaking, now it's from Michael, and Michael has. I should say that he's generally very supportive of the podcast and very kind in what he writes, but he does have some provocative questions that he wants to ask us. So I think we should take it in with a bit of a smile when we hear them too, and not get too excited about it, but give him a little bit of feedback and pushback maybe on some of the things that he's talking about. So basically he's writing, provocatively speaking, why even bother to do research and backtest? I gather from your talks that 1, you do not really want to do a lot of optimization because that might make the systems less robust. 2, you don't believe that there is a perfect system. 3, you do stick to your systems even if they do not make money for some years. 4, the future will not be like the past anyways, but different. 5, some of the biggest trends might be happening in markets that have not trended for years or even decades. 6, the really big events, black swans that may shape the biggest trends, cannot be foreseen or backtested by definition. And 7, all the CTAs are highly correlated amongst themselves anyways, so the very exact methodology may not matter that much in the end. So what are you actually looking for when doing research? So thanks for those comments, questions, Michael. Let's hear your thoughts. Jerry, what are your thoughts about these statements?
That's got to be one of the best questions I've ever heard. I want to hire this guy for my research team. I agree with all of that. Actually, yeah. I definitely have said before, I think we should take as little from the back test as possible on purpose. Try to rely upon it as little as possible. And the best way to do that is to concentrate almost exclusively on the trading statistics: average win, average loss, average trade, win percentage, win-loss ratio, and we're done. We're done right there. And build that system with healthy internal stats, and be very careful about extrapolating the equity curve, historical back-tested equity curve that's produced. I don't want to use that, but I want to look at those trade stats, and that answers a lot of his questions.
It does, but but here's if I'm trying to maybe dig a little bit deeper. It's not that I disagree with your answer, but trading stats comes from the backtest, right? So we do backtesting to extract something, even though we say don't rely too much on any one thing. It's the overall stats that are important. But of course, every time we do a backtest, we get a different set of stats. So if we're going to dig a little bit deeper and say what is it really we're looking for in order to get to the stats that we feel comfortable with, is there a way to explain that?
Well, one of the things that I've said many times is what we're getting from the backtest is this is I'm choosing my words very carefully here. This is a pretty good place to buy. It's a pretty good place to sell. We're done. That's right. It. Now, I think another way, another cliche that people throw out is, well, something along the lines of, well, if my max drawdown on the back test was X, so I'll kind of know if I exceed that in the future, the system is broken. No. It could be a lot worse than that. And, that falls apart on many different levels that we don't have to get into. But looking at history and how it's behaved and how CTAs have behaved and how we've done when the S&P goes up or down, and this is what I'm saying, get away from. All you really know is it's a pretty good place to buy, pretty good place to sell. The drawdowns could look a lot worse in the future. and the future is not going to look like the past. The profit's going to come from different places. And then force yourself. This is a basic that I almost glossed over, because he also said we trade markets that haven't made money in the past. The future trades may come from markets that haven't made money in the past. Exactly. So when I say look at these trade stats, it's even worse than that. It's adding up all the trades in every market, in every sector, and the longs and the shorts, and saying that is the number. You can't split the longs and the shorts out. You can't split the currencies. I was on the phone the other day, and someone was saying to me, I know that on subjects like this, no one agrees with me. I've never had anyone say, "Oh my God, that is just amazing." So I have lots of experience, and maybe I even desire this. I'm just seeking out areas where I can get no one to agree with me. It feels like that sometimes, but someone brought it up to me. Shorts are different. Interesting. Short stocks are way different. You have to have a way different way of attacking this. I am 100% confident that if I looked at the short stocks and broke them out, I'd see a much different patterns, and the system that maybe I should trade with that would look a lot different, the parameters, than the other shorts or the other markets. But it gets to the heart and the core of what we do, which is not doing things like that. We want a large sample size, and we sort of say, all of these trades, long and short, every sector, every market, it's the same. It's the exact same. No market or sector or position has a certain personality and historical pattern that I should pay attention to. And so this is where I am. I love this guy. I love this question. He's 100% right. I need to get it in writing. Please forward it to me. I love it.
Absolutely. Sure. And I think if I'm going to interpret what you're saying and then maybe sort of round it off, and I want to hear your views as well, Moritz. I think what you're saying is that we kind of look at these backtest results, and once we get to what you also tweeted, once we get to good enough, we shouldn't worry too much. And in a roundabout way, what I think you're saying, Jerry, is that we just want to make sure from these different backtests that we're not doing something completely stupid, meaning we picked something that has never made money.
That's right.
Is that, yeah.
That's another good way of putting it. What I have chosen, I'm very humble about, and but look at that track record. Still, very humble about it, and at least I do know that it has at least worked in the past. Is it going to work in the future? Don't know. I have multiple entries, multiple exits, different parameters, so I'm not even buying into that. That I'm going to choose the best performer or trade that only. So I get nervous when Moritz doesn't talk. So please comment.
So let's hear from Moritz. Let's get the wise words from our sensible German friend.
Oh God, I think you summed it up real nice. I like that question too. I think the core question is, why bother doing research? And it's kind of like, okay, I could be just sitting here and be done and trade, say, a simple 200-day moving average system and never look at that again. Now, what I do in my research is, and we've had that on that podcast before, is like we have our trend following commandments, which we must never violate, right? So within that framework, I'm looking at things that may impact the system and potentially improve it. I heard you guys speak about, when I was off skiing for the week, I heard you guys speaking about forcing the stop to become closer to the market as a function of time, right? So you have a 2-year trend, you have a 3-year trend that's ongoing, and maybe then you change your stop and you kind of like you force a close out and a profit taking, things like that. I've looked at things such as, if I've entered a trend, say I'm entering a trend on the long side, and that trend starts, the trade starts working. It goes in the direction I want it to go for the first 5 days, for the first 10 days. Does that mean anything? Is there maybe value in saying, okay, I'm now going to give that trade a bit more room, and maybe not tighten the stop up if, say, you're using a trailing stop methodology, because maybe it now has a greater probability of working than other trades. Didn't find that to be correct. But it's those type of things that, I look at. I want to see if they make sense and to what extent they impact those very important statistics that Jerry mentioned. I think they are extremely important. You're not done by looking at the Sharpe ratio of your system. I think that's pretty meaningless. Or just the maximum drawdown. Of course, you want to see what the maximum drawdown is, but none of that is really informative. You want to have the full statistics, number of trades, average gain, average loss, those type of things. And you want to see what your new research does to those statistics and how they're being impacted. What does volatility control do to your average loss? Things like that, right? And that is, I think, very important research most of the time. That research, I don't want to say it leads to nothing, because it leads to a very valuable result. The result is don't do anything, don't implement it. But by doing the research and committing yourself to it, doing it within our trend following context without violating our commandments, it kind of like we're forcing ourselves to be open-minded, exploring new things. But kind of like you go back to the center of where you started, and you come to realize, just as Jerry said, it's just good enough, and probably that just good enough is the best that you can get.
Yeah, I mean, could we even go as far as summing it up to say that a lot of research and a lot of the things we do is to find the things that doesn't work, so that we end up focusing on things that actually work, but not necessarily is the best, but it just works and it's good enough.
Yeah, I think there's some truth to that.
Yeah.
And to some degree, when looking at alternatives and hearing what other people do, if you normalize the return, your potential return based upon the back test. Let's say we have two traders that they're conservative, they have lots of assets under management, and they're both trying to make about 10% a year, or have a low 10 vol or 12 vol or something like that. So what is the outcome then of adding things and overfitting or optimizing or just making it a little bit better? You'd have a little bit smaller drawdown. Yeah, so one guy's going to make 10 with a 10% drawdown, one will make 10 with a 14% drawdown. It doesn't really, really? And then you're going to put yourself like in more of a wobbly, less of a solid foundation. Yeah, it doesn't add up. We're going to make the same amount of money. My drawdown will be a little bit larger, and I could be wrong. You could have been 100% correct that you didn't overfit, you didn't add parameters that you shouldn't have. You were right. I should have done the same thing with vol targeting or take profits or whatever little minor thing that I would complain about. But I had a great career as well, and my max drawdown was 4% more. I think that's a pretty reasonable trade-off. If you're conservative and would rather err on the side of ironically, you will have a system that has more volatility, but you've actually erred on the side of being conservative.
Yes,
absolutely. And I think still it goes back to this view that I don't think many people realize or agree with, and that is in many respects what we do as managers, what we do as an industry is actually a lot less risky than many of these passive investments that people seem to love. And so, yeah, interesting.
If I could just comment on that, I agree totally. We have a few minutes ago when you were talking, I wanted to say something like, with the more markets you trade and the better the systems are, and if you add single stock futures and diverse markets and multiple entries and exits, your performance will just get less extreme, less on the upside, less on the downside. That's the theory, right? So I'm going to be a lot more boring than most people because I'm not going to be number one very often. I'm not going to be in last place very often, although I'm giving it a shot, I think, these days. But I think that's kind of where we want to be. And as an industry, that's exactly right. You can't get more diversification. You can't get more risk control. Oh, darn, we messed up because our vol is higher than the stock market. It's higher than we have to make excuses for our vol sometimes. And then our volatility and our bigger losses and our bigger wins, they're usually just going to be due to that. They're going to be due to we take on more risk. So that's we kind of shot ourselves in the foot by not, as I've said before, the S&P is roughly an 8% strategy, 8% per year with a 50 plus drawdown. So we should have a product. Our main fund should have started from day one to mimic that 8% with maybe a 15 or 20% drawdown. But we were like, oh no, that's leaving money on the table. Let's go for 15 or 20. So then we were down 40. And as you said to start the podcast, well, we're risk adjusted. We're not that bad. Well, that's a really tough sell. Dude, I'm down 20. Yeah. I mean, tell me why again. I'm not down 20. Oh no, you're down 20. Sorry about that. But just know one of these days I'm going to make it up on the upside. And that's just difficult.
But I mean, we shouldn't forget that, of course, the market that people tend to love, like equities. I mean, the S&P was down 9% in December alone. I think it was the worst December since 1931. So it's not like these markets don't have the ability to lose a lot of money in a short space of time. And the S&P is was certainly at one point down more than 20% from its recent high, and I think that is more than any of the CTA indices have been forever, really. So, we maybe we sometimes get ourselves into a little bit of a model by just choosing the way we describe things. But we're certainly going to try to change that worldview with our little podcast here. So thanks so much again to Michael and George for the questions. Keep them coming. Send them to info@toptradersunplugged.com or tweet them to Jerry, and we will try and do that. And if you are listening to this podcast episode before Monday, the 7th of January, so essentially later on today, Saturday, or tomorrow, Sunday, I will be interviewing a really, really interesting person on Monday, namely Andrew Lowe, kind of the inventor of the adaptive market hypothesis and a really, really smart guy. So if you have any questions that you can quickly send over to me that you think would be interesting, I will try and bring those up. But otherwise, I hope you'll tune in and listen to that episode once it's ready, because I think he has an enormous amount of wisdom to share. Anyways, let me just run down a few performance numbers here for the first week of January. Now, again, as usual, these are as of Thursday evening, so not including Friday's big move. So they're probably a little bit more positive than where the week ended in practice, but let's just run through it. Obviously, the month to date is also the year to date. So let me just run through month to date. We have the BTOP 50 index up 57 basis points to 0.57. SocGen CTA index up 0.82. SocGen trend up 1.17. And the SocGen short-term traders index up 0.99%. And then the Bridge alternatives was up 0.13% for 2019 so far, the first 3 trading days at least. Any closing thoughts, Jerry, Moritz, that we should think about? Well, maybe I'll throw out one thing that we, just to see what maybe we get a reaction from our listeners to this. But one of the things we have been talking about and seeing if we, and let's see if that's something you guys think would be interesting. And that is also to simultaneous to recording the podcast. We were thinking of doing it on a Facebook Live as well, so that you had the opportunity to engage a bit more real time. Obviously, we do our recordings generally on a Saturday or a Sunday, sort of early morning Eastern time. So that's one thing we were thinking about doing in 2019. So if you think that could be great, if it could be fun, or not for that matter, let us know one way or the other, because we want to experiment and see if there's other ways we can create value for you guys, and maybe having a more live interaction with you and taking your questions on the fly. Maybe that would be something that you like. So what else, Jerry, Moritz, that you think we should bring up before we close down for this week?
Important thing to bring up is belated Happy New Year, everyone, and cheers to happy trading.
Yeah, definitely. Cheers to happy trading.
Yes, I agree. I don't think I should add anything else. Happy trading, and stick to your systems.
Yes.
Absolutely. Absolutely. Well, on that note, we're going to wrap up this week's conversation, and we hope you enjoyed it. As you know by now, we certainly enjoy making them for you. And as usual, I'm going to finish off by saying that if you get some value from these conversations, we do really would like you to share with your own followers and spread the word, because not only would it help us and find other people to discover the Systematic Investor series, but on a personal note, I actually think the next few years can be incredibly important for investors around the world. It can probably either make or break you. So if you don't have a true diversified portfolio, if you don't have good rules to follow one way or the other, I think it can be a really tough period for investors out there. So there are many reasons why we ask you to share and review the podcast. And thank you to all of those of you who have already done so. From Jerry, Moritz, and me, thanks so much for listening. And we do look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.